You keep hearing that the economy is in trouble. For millions of people, inflation is a daily reality. The housing market feels locked, and the American dream is drifting further out of reach. Consumer sentiment is scraping near record bottoms. Yet the macroeconomic data tells a confusing story. Despite that widespread misery, Americans are somehow spending money at a faster pace this year than they were in 2025. This spending isn't coming from the general public. A tiny, ultra-wealthy fraction of the population is single-handedly keeping the American economy afloat, and they are doing it with stock market money. This level of wealth concentration has evolved into a systemic liability. The widening gap has created a dangerous economic catch-22 that traps the entire system. According to the Dallas Fed, the top 20% of earners now account for 57% of all U.S. consumer spending. They are doing the heavy lifting for the entire country. Part of that power comes from physical assets. This group bought or refinanced homes at sub-3% rates during the pandemic. Today, they own more than half of America's overall home equity, while the bottom 20% owns just 3%. But the real accelerator here is shifting from real estate to the paper wealth generated by the stock market. Federal Reserve data confirms that this same top 20% controls a massive 87% of the wealth generated by individually owned stocks in America. Those gains have a psychological impact known as the wealth effect. The S&P 500 has posted 327% return over the last decade, making this group feel financially invincible and prompting aggressive discretionary spending. Over the past year, this market-generated spending amounted to an estimated $53 billion. That single dynamic accounted for a seventh of the entire U.S. GDP growth rate last quarter. The positive GDP growth touted in national headlines is essentially a byproduct of Wall Street paper gains funneling strictly through the wallets of the top 20%. Relying on a K-shaped economy, where the affluent drive the data while everyone else struggles, is a massive systemic liability. If the top 20% are holding up the economy, we have to look at what exactly is holding up their stock market portfolios. The market is incredibly top-heavy. 1/3 of the S&P 500 is tech, and nearly a fifth is just chip stocks. The AI expansion relies on hardware demand, but even a natural cooling of that demand presents a massive risk to the whole structure. If the tech rally stalls, the wealth effect vanishes. When the top 20% stop feeling rich, they immediately close their wallets. If that 57% pillar of consumer spending snaps, the entire U.S. economy risks a sharp retraction or a full-blown recession. Historically, we are taught that the stock market is not the economy. But today, because wealth is so severely concentrated at the top, that distinction has disappeared. The market is the economy.